Good morning, everyone. I'm going to get started. Hope your weeks are off to a good start. A couple things that I wanted to mention. First, we had originally planned to have your sixth and final problem set due this Thursday or Friday in section, but hopefully you've seen that we've extended it to be due next week on Thursday or Friday in section. So just wanted to flag that. And then additionally, next week on Tuesday, we're going to have for a guest lecture for the second part of class, Jonathan Coslet, who's the chief investment officer of a private equity firm called TPG, who knows a lot about macroeconomics and how it matters for financial markets. I think it'll be a really interesting class. And as I did for the two previous guest lectures, I'm organizing a lunch after. And anyone can sign up for this. Anyone in the class can sign up for this, even if you've been to a previous one of these lunches, which I think will be really interesting after class, like at 11:45, let's say, over at CEPR. And let's see, anything else, Laura, that I should be mentioning? Okay, great. So do you guys have any questions from last time? So we've got 4 more classes in the course, and we'll be doing more macro today and for the next 3. And let's see, today we're going to be building on what we talked about last time, the aggregate demand and aggregate supply model. And first we're going to talk about the Keynesian perspective in this model. So we talked a lot a couple weeks ago about how aggregate demand has 4 components: consumption, investment, government spending, and net exports. These are the 4 components of aggregate demand. And in Keynesian economics, there's, in the sort of Keynesian perspective in this model, we basically, we had talked previously about, let's say this horizontal axis is the level of output in the economy, and the vertical axis is the price level. So you can think of there being some sort of aggregate demand curve that exists that captures, and we talked a bit last time about why this was downward sloping. In the Keynesian perspective, due to sticky prices and sticky wages, the aggregate demand curve is essentially horizontal below a potential GDP point. So this could look like as follows. Short run aggregate supply curve in the short run. So that shifts in aggregate demand, and this could be at this sort of potential output level, shifts in aggregate demand translate 1-for-1 into lower output. And if the drop in aggregate demand is sufficiently large, that can lead to a recession. And so it's important to think about when we're considering whether aggregate demand is shifting, think about which of the 4, or maybe 2 or 3 of the 4 are shifting simultaneously. In this case, we have output below the potential output, so we'd have unemployment above the natural rate of unemployment. And so I want to talk a bit about what are the factors that can influence all 4 of these components of aggregate demand. First, with consumption, there are several factors that drive people's decisions about how much to spend on goods and services. So one is disposable income. This can rise and fall depending on what, like if a person loses their job or if taxes increase, they have less money to spend, and so that's going to tend to lower the amount of their total consumptions. That's just income today, but also an important factor for consumption spending can be what are the expectations of future income. So if you suddenly are working and you start to think that you're likely to be laid off, or you know that your job is coming to a close for some reason, then that could cause you to pull back on consumption spending relative to what it otherwise would be. Alternatively, you may be switching to a better job, and so that could lead to you expecting to have higher future income. And this is happening over and over again for tens of millions of people in the US economy and for people in other economies all over the world. And when we think of things at a macro level, we're trying to aggregate up all of these things. So at any point in time, you've got people who are maybe losing their job, other people who are switching to a better job. And at a macro level, the question of whether you can sort of average over all people to get a sense of whether expectations are rising or falling. Wealth is a big factor, and how much access to credit people have. So this can be financial wealth, like the amount of money that people have in the stock market, or non-financial wealth, like housing prices. And we talked a bit last time about how massively house prices in the US had changed about a decade ago when we were in the Great Recession, and it hit some markets much worse than others. On the financial wealth, so if we look, I just want to show you, keep ink annotations, yes. If we look at financial wealth, one factor that greatly influences financial wealth is the value of the stock market. So if we look over the last, let's say, 6 months at the stock market, you can see that about 2 weeks ago, the stock market started to fall, and it fell quite a lot, by about 15%. It's come up a bit since then, but one of the things policymakers are very worried about is whether that massive decline in financial wealth of 15% is going to cause people to pull back on their consumption spending, and that could lead to basically a leftward shift of aggregate demand. Let's see, okay. And you can see just from the peak to so at the peak, this was up around, the S&P 500 is a measure, it's an index for the US stock market, and it was up around 3386. Oh yeah, that's not going to work. 3386 on February 19th, and it had fallen down to 2954. So that's about a 15% drop over a pretty short time period. Okay, let's see, and then I want to put this here. The amount that people want to save is also an important determinant of how much people are consuming. So to the extent that people suddenly start saving a lot more of their money, as this rises, then consumption is going to tend to fall. And this consumption spending includes both durable and non-durable goods, and it also includes services. And so changes in any of these factors at a macro level, changes in disposable income, changes in expectations about future income, any of these factors can influence that big C in the aggregate demand equation. Okay? Similarly, what drives private investment expenditures? This is mainly about businesses. So companies like General Electric, companies like Lockheed Martin, companies like Amazon, how much are they deciding to invest in equipment structures and inventories? And a big factor driving these decisions is what impact is the investment likely to have on future profits. And a big determinant of this expectation is what is the level of business confidence. So how confident are businesses about their future profitability if they expand somewhat, if they add a new warehouse, if they add a new manufacturing facility? What is that going to do for their profitability? And this is a much more volatile component of aggregate demand than is consumption. So if you look over time at fluctuations in total investment, in percentage terms, it's fluctuating much, much more than consumption. Another component of private investment expenditures is residential structures. So this would include housing construction or additions to people's houses. But interest rates are a really important driver of this as well. So to the extent that if interest rates go up, then for someone to borrow money to buy a house, it becomes harder. Yeah, question right here, sorry. Yeah? Great catch, yeah.
On the last slide, what is a durable and non-durable good?
So a durable good might be a vehicle or a dishwasher. A non-durable good could be food, it could be clothing. I mean, I guess clothing isn't somewhat of a blurry territory, but a lot of consumption is in durable goods, but food is a classic non-durable good. Is that helpful? Yeah? Okay. And the government can directly influence this. So it can put in place investment tax credits to try to make it more profitable for companies to invest. It can change interest rates. So just today, we're going to be talking about monetary policy in a little bit today, but if I go to, let's suppose I go to WSJ.com, you see the huge headline on the Wall Street Journal today is that the Fed cut rates by a half point to combat virus fear. And partly, they are doing this because the Federal Reserve, and we're going to talk more about what the Federal Reserve is and what its history is, but they're worried that all of this concern about coronavirus is going to lead to a huge drop in business confidence and consumer confidence. So they're basically trying to cut interest rates to try to stimulate demand somewhat, okay, and avoid things going into a sort of downward negative spiral. So that's a big change, as we'll talk about in a bit. And this was sort of, but you see that the stock market is still falling today, and so there's some, it's not like that immediately solved this issue, okay. Okay, so investment's a really important factor. Government spending is a hugely important factor. So as we talked about, government spending and investment account for about the same share of GDP. So we've got G for government spending and T for taxes. And this is including the federal government, individual state governments, and local governments. And if we were in other countries, it also includes the federal government and their local governments. So taxes can change at the individual, family, or business level. Services that the government provides include education, healthcare, police, and fire, or public goods like the National Institutes of Health or national parks. Military procurement is a big part of government spending. And in the Keynesian view, this is an important thing to take away from today. In the Keynesian view, governments are really important when the economy is in a recession. So if, for whatever reason, the economy started to sputter and growth started to slow down and unemployment started to rise, in the Keynesian view, the government should come along and either cut taxes or raise government spending. Let me just get a good cough in, sorry. I hope. Okay. Let's see. I don't mean to make light of it. It's obviously very serious. But I do hope that I hope none of us have coronavirus. Okay, net exports are heavily influenced by economic growth in the U.S. and abroad. So if the U.S. economy is growing much more rapidly than the economy in other countries, that's going to tend to raise our imports and lower our exports. So net exports are going to fall, and relative prices can also matter to influence this. If the U.S., if we're becoming more and more productive, that's going to be a spur to our exports. So here you can see this is a nice table taken from the OpenStax that looks at reasons for either a decrease in aggregate demand or reasons for an increase in aggregate demand. And so you see that right now there is some concern about a drop in business confidence and consumer confidence for that matter. And so partly the Fed right now is trying to offset that through a drop in interest rates, okay? So you can find this table in OpenStax. I believe it's in chapter 25 of OpenStax, okay? And so there are reasons you can see in consumption. If income falls, that's going to tend to decrease aggregate demand. If wealth rises, that's going to tend to increase aggregate demand, and so forth. But the government spending, this is government, both taxes and government spending. This is something that you hear a lot about from policymakers. So we hear a lot about it from Bernie Sanders or Joe Biden or Donald Trump, what their proposals are for government spending going forward. Okay. Pause here for a second and see if you guys have any questions on this, because I've gone over a lot of big picture concepts. And okay, looks like we're all good. So why recessions occur and adjustment is slow. So aggregate demand, for various reasons, may be insufficient to reach potential output. So right now, we're in a good place in the U.S. economy. abstracting for a minute from the drop over the last couple of weeks, but unemployment's really low. Output has been growing fairly strongly relative to other industrialized countries, but the aggregate demand curve can shift sharply due to changes in housing prices, changes in the stock market, and so forth. So it is, and partly, this output drop can be larger if wages and prices are sticky. So wages can be sticky, so the minimum wage, or we talked about contracts that firms may have with their workers. So if aggregate demand plummets, it may not be the case that a company can immediately turn around and lower their employees' wages by 5 or 10%. Okay, similarly, there are menu costs associated with changing prices, and so this can lead to a big drop in demand. So you can see this. This is once again just repeating this figure that I showed you a second ago. Here we've got the short-run aggregate supply curve, and shifts in aggregate demand are leading to one-for-one reductions in real output. Okay. And so this horizontal SRIS curve comes about because of sticky wages and prices. Now, it's not the case that all wages and prices are totally sticky, but a lot of them are. And so the magnitude of that stickiness is going to govern how steep or flat this curve is as we go to the left. But the Keynesian view would say that if aggregate demand is shifting here to the left because of some fall in confidence or some other factor, that we should, let's say, put in additional spending by the government to try to shift this aggregate demand back so that we don't fall behind in terms of output being way below its potential level. Okay. And so the more realistic shape for the assumption of an L-shaped short-run aggregate supply curve is unrealistic. A more realistic one looks as follows, where basically the slope gets increasingly steep as we move from the left to the right. In this area over here, which you can refer to as the Keynesian zone, things are relatively flat. And so a shift in aggregate demand. So this is when the economy is way below potential. So right here, this is the potential level of employment here. If we're way below potential, then if we can do something to increase aggregate demand, that's going to translate almost one-for-one into an increase in total output and have very little effect on the price level. Whereas instead, if we're all the way up here, if we're operating already at potential and we do something to shift aggregate demand, it's primarily going to feed into price increases, okay? And so the idea of this kind of a relationship between output and the price level, P, and this P could be a CPI, or it could be a GDP deflator. Okay, probably GDP deflator is the better one. Translates, so if this kind of maps into a negative relationship between the unemployment rate and the inflation rate. So if we think over here, if we're in the Keynesian zone and unemployment is relatively high, pressure on the price level is pretty low. Whereas if we're up here in the neoclassical zone, then pressure on the price level is going to be much higher. And this idea was famously put into practice as what economists referred to the Phillips curve. And this Phillips curve in the 1960s included those dots right there, indicating a negative relationship between unemployment and inflation as that model would predict, okay? And so this Phillips curve worked during the 1990s, the idea of a negative relationship between unemployment and inflation. So that worked in the 1960s, but we talked last time in class about these two big events that happened in the 1970s, these oil price shocks, which simultaneously led to both, and so that was that caused a shift in the short-run aggregate supply curve, and that raised both unemployment and inflation. So these dots here suggested the Phillips curve worked from the 60s, but these dots out here from the 1970s suggested there was not a clean negative relationship between unemployment and inflation as predicted by that model that focuses on the role of aggregate demand. I'm going to pause there so you guys can get that down. Okay. So the Keynesian approach is really favors activist fiscal policy. And so the Keynesian approach was sort of, so the idea is that if demand is low, that we should increase government spending. And this tends to, if demand is low and the government starts spending more on, let's say, education, or more on healthcare, or more on defense goods, or more on police, that tends to shift the aggregate demand curve to the right. And you can get a high bang for the buck if we're in a recession. But it also suggests contractionary fiscal policy if output exceeds potential, because if output is exceeding potential, we may get the price level to rise. One challenge for any action by the government is it's very difficult for policymakers to get the timing right. So if the economy is starting, like right now, we could be at the beginning of the economy starting to decline somewhat. It's hard to predict exactly, but we're putting into effect possibly some policies, and it can be difficult to get the timing right. So sometimes the spending, if you think of government spending, can kick in just as the economy is starting to recover, and it can lead output to overshoot potential GDP. Okay? The Keynesian approach was hugely influential in the US and around the world during the Great Depression, and it provided the justification that FDR and other policymakers needed for really aggressive spending on what was called the New Deal. But it was also influential, very influential in the last year of the Bush administration, George W. Bush administration, and soon after when President Obama took office. And we're going to talk a lot about this pretty aggressive stimulus package known as the American Recovery and Reinvestment Act, which consisted of $800 billion in new spending and tax cuts that were designed to counteract a huge reduction in aggregate demand. And it was highly, highly controversial. So basically, this is an area where economists who are lean more democratic tend to favor more government interventions, whereas economists who lean more Republican tend to favor more just let the market work, don't try to tinker, don't try to fine-tune. Okay? Any questions on this? Everyone seems good? Okay, great. Okay, so that was the Keynesian perspective in the aggregate supply. And oh, we've got a question. You have the microphone, Cube. So,
how is it possible to overshoot potential GDP?
Right. So potential GDP is not. It's a great question. How is it possible to overshoot potential GDP? So potential GDP is not meant to be what is the absolute maximum that output can possibly be. It's sort of the level of output that's consistent with all inputs being fully utilized. You can get above potential GDP if companies start hiring workers, like having workers work overtime and running their factories more for longer periods of time than is sustainable in a long run perspective. So suppose the economy tanks because of the 15% stock market drop last week, and suppose that the government immediately responded to that by giving everybody a tax refund of $400. Okay, so that money goes out, everybody gets $400, but suppose that even before they sent that money out, the stock market was starting to recover. Do you know what I mean? And so people's spending was starting to get back to regular, and now they've got this additional thing that's coming in. So it's hard to get the timing right, and it may be, if you think of it in terms of let me try to see if I can do this. I'm going to try to insert just a new slide, blank. Okay, let me try to, suppose we think that over time, suppose that like potential GDP is kind of growing like this, 2% a year, and it's fluctuating above and below as we get unemployment versus not. Suppose that we're down here and we start to introduce some new spending, so this is Y, but things were already starting to recover, You know what I mean? And so instead of overshooting just a little bit, it may overshoot more as a result. Does that make, that's mathematically what I mean by it. But conceptually, the idea is the economy may have started to recover on its own even without the additional stimulus. And so that is the Keynesian view says get in there and actively intervene, whereas the neoclassical view that I'm going to be talking about says, don't tinker, don't fine tune, it'll just make things worse. It's better to just let markets work and reach their own equilibrium. Okay, hopefully that makes, does that, yeah? Okay, great. Okay, so the neoclassical perspective is very different from the Keynesian perspective in this model. And it focuses mainly on the determinants of potential GDP. So it's much less focused on the short-run fluctuations. And it's basically very focused on the vertical long-run aggregate supply curve at potential GDP. What can we do as, let's say, government policy to increase potential GDP? And so economists who fall into the neoclassical camp tend to favor doing things that will reduce distortions, such as high marginal tax rates or minimum wage. Okay, these are distortions that can reduce output below its efficient level. And the neoclassical perspective argues that wages and prices will adjust flexibly to short-run fluctuations, and that it's not great for the government to intervene because government intervention will exacerbate the swings and potentially increase inflation. So I'm going to show you graphically the neoclassical perspective on how things change. Suppose that we start out and we initially have aggregate demand curve AD0 and short-run aggregate supply curve SRAS0. And let's consider the effects of a shift to the left in aggregate demand. So this is taken from the OpenStax textbook, where for whatever reason, suppose businesses and consumers suddenly become less confident. Okay? And so what that means is that at any given level of the price level, companies are going to spend less on investment, consumers are spending less on consumption goods. Okay, so this moves to the left. Now what the Keynesian perspective would argue is, okay, we should try to do what we can instantly to try to counteract that reduction in output through activist fiscal policy. Let's give people a tax cut, or let's increase government spending in some way to try to shift back aggregate demand to AD0. But what the neoclassical framework says is that instead, if you just sit tight, what happens at that point, E1, is unemployment now is higher than its natural level. And as a result, workers are going to have less bargaining power, and they're going to tend to, wages are going to tend to fall. Okay? That means that that's the price of an input, wages. And so as wages fall, at any given level of the final price level, so this is the price level over here, companies are going to be willing to produce more, and this will cause a shift to the right in the short-run aggregate supply curve, so that we end up back at potential GDP. Okay? So basically what has happened is we see some kind of perturbation to aggregate demand that lowers it. Okay, the neoclassical perspective would say just sit tight, let the market adjust through the shift in the short-run aggregate supply curve, and we'll get back to potential GDP more quickly. Okay? And so this is just, with words, consider what happens after a reduction in aggregate demand. Output falls below potential GDP. Unemployment then rises, which leads to a fall in wages. The parentheses are just the opposite, like I do it for both scenarios here. And so the short-run aggregate supply curve is going to shift right, which brings output back to potential output. And this process occurs without any government intervention. Okay, so economists, it's not like some economists are purely have the Keynesian view and other economists purely have the neoclassical view. But in general, how much an economist favors government intervention when the economy starts not to do well is, it varies a lot. Okay. So, but there is this question of how quickly is any adjustment going to occur? So, basically, if we're sitting out here with high unemployment for a long time, and the neoclassical economists are telling the president to be patient, just let the market adjust, and we'll get back to this potential output of 500 and the natural rate of unemployment. But sticky wages and prices can slow the pace of adjustment, okay? And so how important you think sticky wages and prices are depend on whether you have more the Keynesian view of the macroeconomy or the neoclassical view of the macroeconomy. The speed of adjustment could depend on the magnitude and the duration of the shock. So if we have a smaller shock, the adjustment is likely to be quicker, whereas a really big shock, like we saw in 2007 and 2008 when housing prices fell massively and the stock market fell by more than 50%, that may have taken more time, okay? But there is, the neoclassical view would have this rational expectations hypothesis that basically people are going to expect this adjustment will happen. Workers and firms will recognize that output is below, let's say, potential output, and a rapid change in price can happen with very little friction, okay? But you may think that a year or two is not very long to wait, or 2 or 3 years is not very long to wait. How long this adjustment will, how long this will take is not obvious, and estimates of it differ. But we're going to talk a lot in class on Thursday about the American Recovery and Reinvestment Act, this $800 billion stimulus package. It was the first thing that President Obama focused on in 2009 when he got into office. It was a big increase in government spending, and it was hugely controversial, with some economists thinking it was too small, and other economists thinking we shouldn't have done any of it at all. Okay. So this given this difference in views between neoclassical and Keynesian, sort of more Keynesian view, the neoclassical view is that short-run interventions are likely to amplify changes both in output and unemployment, okay? So, in other words, in the neoclassical view, in the absence of government involvement, we might see fluctuations like this, whereas with government involvement, the fluctuations might be much greater, okay? And so it's better for governments to not try to intervene because it's going to be hard to get the timing right. It's going to be hard to know what the effect of the policy will be. So it's better for policymakers to do no harm and to not try to fine-tune things. So it's difficult to time the intervention well, and it's also difficult to know the ultimate impact. And so the neoclassical view prizes over everything, trying to create conditions that are very favorable for long-run growth. And so aim for basically reform the tax code and government programs like unemployment insurance, lower distortions from the minimum wage. Basically, it's more of a, like, let the government step back, let the market work, and higher output will result from that, okay? So it's interesting, partly because of it's not necessarily the case that all Democratic presidents or economists fall into the Keynesian camp and all Republicans into the neoclassical camp. Back in 2008, when it was clear that the economy was starting to have some not do so well, the government, and President Bush was very much behind this, put in place a set of tax rebates. And basically, these tax rebates were given to people of $300 per individual $600 for married couples, and these checks were sent out over the course of about a 2.5-month period, and these were implemented in an effort to try to accelerate growth. So the economy had not been doing that well, and it was starting to fall into recession, and so one of the criticisms of activist fiscal policy is usually that it takes a long time to get the money out to potentially increase aggregate demand. And so what this policy tried to do was very quickly get money into the hands of people, and this was a sort of an unconventional type of activist fiscal policy, and they did something that was pretty interesting. So they could not logistically send all of the tax rebates at the same time to all individuals. So depending on the last digit of taxpayers' Social Security numbers, they would get checks in different weeks. So basically they had 10 different times when these checks got sent out. So maybe if your last digit was a 0, you got the checks in the first week. If your last digit was a 1, you got the checks in the second week, and so forth. And that variation across people in the timing of when those checks went out was used to try to estimate how much did it increase consumption, okay, consumption spending. And this approach, so there was a CBO report that talked about this, that of the money that was dispersed, and if I remember right, I think it was about $80 billion that was dispersed, only about a third was spent within a year. Okay, so it wasn't. Part of the hope, I think, of people had been that this $80 billion would counteract the fact that many people were losing their jobs, many people were seeing their stock market or housing values go down a fair amount, and only about a third of it was spent. More of it actually was spent for people to pay down their debts. But these 2008 tax rebates did stimulate short-term growth a bit. But they, basically it's about a third of that went into this. So it's not like the Keynesian view is right and the neoclassical view is all wrong, or vice versa. There's, to some extent, the wisdom of either approach depends on the time period that you're looking at. So there is Robert Solow, who we talked about with the Solow model. This is an interesting quote of his. At short time scales, I think something short of Keynesian is a good approximation, and surely better than anything straight neoclassical. At very long time scales, the interesting questions are best studied in a neoclassical framework, and attention to the Keynesian side of things would be a minor distraction. At the 5 to 10 year time scale, we have to piece things together as best we can and look for a hybrid model that will do the job. So there's this sort of balance between the Keynesian and neoclassical view. In the short run, if what we're seeing in global stock markets right now ends up leading to some kind of a recession, then maybe the Keynesian view will prevail in terms of policymaking. So this balance thing made me think of an interesting video that I thought you would enjoy as a little diversion from what. So let's see how we're doing. Oh, the stock market is down a fair amount. Let's hope it does not continue. So here we go. When we're thinking about this balance, have any of you seen this before?
I've had my ups and downs, my fair share of bumpy roads and heavy winds. That's what made me what I am today. Now I stand here before you. What you see is a body crafted to perfection, a pair of legs engineered to defy the laws of physics, and a mindset to master the most epic of splits.
Who can say where the road goes, where the day flows? Only time. And who can
carried out by professionals, so don't try that at home, please. I don't know what the parody funny video is.
You know what
Yeah,
he'll
sorry,
do
okay.
by-
You want to go back to the parody funny video? All right, whatever. What the hell? You only live once. Okay, let's see. Wait. Okay, so this is. Oh, come on, I can't skip ad. Let's see. Okay, here we go.
Some says that ever against that season comes, when our Saviour's birth is celebrated. The bird of dawning singeth all night long. And then they say, no spirit can walk abroad. The nights are wholesome, then no planets strike, no fairy takes, no witch had power to charm. So hallowed, and so gracious is the time. So I brought you that.
And say where the day flows, only time.
Merry, Merry Christmas, and Happy New Year to you all.
Okay, all right. Enough fun. Okay. Little change of pace. So the point of that was to just make the point that there's a balance between the neoclassical and Keynesian view, and it's careful balance. Pretty gutsy for him to have done that, right? So I think the second one may not have been real, right? So anyway, I don't know how quite they did it, but the first one was real. Okay. So let me pause here before I start into the role of money in the economy and see if you guys have any questions or comments on anything so far. Here we go. Can you pass the cube? Oh, sorry. Great catch.
Is there a long-run aggregate supply in the Keynesian view or no?
Yeah, I mean, I think in the background they have in mind that its potential output is, but that potential output is where it goes basically vertical. But even the most Keynesian economists wouldn't say that they think it's literally a flat line and then a straight line. Yeah, but they think it's flatter, and that because prices are sticky down, and so if prices are sticky down, it's going to be hard for the adjustment process that the neoclassical economists think will work, and so we need aggregate demand, a shift in aggregate demand to get us back to the potential output level. Yeah, great question. Okay, other question? We got another question over here. Bring this. Great.
So when you were talking about sticky wages, like, what is the reason that they are sticky? And if they are, and it like poses a problem when there's like aggregate demand decreasing, why doesn't the government like implement a policy to not have wages be sticky and prices be sticky?
So it's a great question. You can come in, Carl. This is my friend. Let's all welcome Carl. This is my friend from back when I was an undergrad, like all of you, and his daughter, who's going to be a freshman here next year. Welcome, Carl. You just missed the Van Damme epic split video. Maybe we can show it to you at the break. But anyway, so we all have to be very well behaved seeing them here. So okay, next question: wages. Why? So I think on the wage front, a lot of people have contracts that specify what their wage is going to be over the next year, 2 or 3 years. So if you look at, let's say, like teachers' unions, they often have wages that say, you know, we're going to get paid $50,000 this year, $52,000 next year, $54,000 the year after that. So that's part of the reason that they're sticky. Also, minimum wages in a lot of states prevent wages from falling below a certain level. So here in California, I believe the minimum wage right now is at about $13 an hour. So if we get a shock to demand and for people who are working at that minimum wage, there's no scope for that to fall to bring the short-run aggregate supply curve back over towards the right. But I think even more important than either of those things is just the norms within firms. So if you look at firms, they tend to prefer not to reduce wages for their existing employees, but instead to adjust by laying off employees. And so I think they do that partly because they're worried about adverse selection. So if you have a choice, you can either lower your workforce by 5% and wages by 5%, or you can lower wages by not lower wages at all and lower your employment by 10%. You may opt for that latter approach because you can pick the 10%. And the fear would be if you lower the wages by 5%, your most productive 5% might leave. So I think those are sort of the three primary reasons that leap to mind right now. Other questions before? Yeah, right over here.
So in the neoclassical view, when there's a shock and the GDP returns to its original level, does the wage also recover, or does it remain at a lower level?
In this model, so this model doesn't do a great job with the dynamics of, it's more of a sort of, the wages will eventually recover because they'll start to, once you get to potential output, then wage growth will continue to grow with productivity growth, but they may be temporarily lower as a result. Yeah, great question. Okay. So let me just take a couple minutes before we take our break to talk about the role of money in the economy. So basically, so if we didn't have money, like dollar bills, $5 bills, $10 bills, and so forth, then for trades to happen, there would need to be bartering. And you would essentially need to find, for bartering to happen, you would need to find someone who both has what you want and you have what they want. So you'd need a coincidence of wants. And that could be pretty inefficient. So instead, we have money that can serve as a medium of exchange. A buyer gives a seller money in return for an item, and it is the most liquid of all assets. Okay? And we're going to be talking about the liquidity of different assets today, but money is absolutely the most liquid of them all. It serves as a unit of account, and it makes it easy to measure relative prices, and also provides a way to store value. You can hold on to it to use it tomorrow, to use it next week, or to use it next year. Now, there are different kinds of money, and the money that all of us are most familiar with is what we call fiat money that has no intrinsic value. The government basically just decree creates its value. So if you look at take out of my wallet a $1 bill, written prominently on the $1 bill is the statement, "This note is legal tender for all debts, public and private." So this money, basically by government decree, is considered to have value, whereas commodity money, for example, which has been used a lot in the past, like gold and silver were the most common and were used for thousands of years. This was basically what we had for a long time, but now we've moved to this fiat money, where basically we have currency, dollars and cents. Our currency actually did used to be backed by commodities. The US dollar used to use gold as its backing, but we went off the gold standard partially in 1933 and fully off in 1971. So right now, the type of currency that we have here in the US is fiat money. And when we define the quantity of money, and this is I'll just get through this slide and then we can take a break. Defining the quantity of money, there are two primary measures that get used. So one of these measures is M1, and it only includes the most liquid forms of money. So currency, which includes cash and coins, is included. Okay, checking accounts are also included. And if you look in January 2020, this is the most recent data from the Federal Reserve, there's about $12,000 in M1 per person in the US. Okay? Now, so this is the relatively narrow measure, and we're going to talk about how the Federal Reserve uses this measure M1 to think about what its policy should be from one year from one day to the next. Then a broader measure is M2 that also includes M1, but it includes some less liquid forms like savings accounts, certificates of deposit. So certificates of deposit are these things that have a fixed time during which you can't access the money. So if you have, let's say, a 1-year CD that you pay $1,000 for, maybe in a year you get $1,020 for, it's not immediately liquid. And then there are also money market accounts. And this M2 is significantly higher. 15.4 trillion in January 2020, or about $47,000 per US resident. But the key point from this is there are two types of money, two measures of the money stock, and it's not simply cash and coins. So the amount that's held in bank accounts is almost 10 times as large. As we'll see, about a little less than half of this M1 is currency. So why don't we just take a break there, 8-minute break, and feel free to come up if you have questions, and see you back here in a few. Okay, let's get started. So we talked a bit about M1 and M2 before the break. So M1 only includes the most liquid forms of money, being currency and checking accounts, whereas M2 broadens that to include savings accounts, CDs, and money market accounts. And you can get a sense of the relative importance of these different things in the following figure. So this is the components of M1. The primary two components are currency at 1.72 trillion and checking deposits of 2.26 trillion, which is almost 4 trillion total. And this works out to about $5,200 in cash per US resident, which seems like a lot of currency to be out in circulation. I'm guessing none of us in this room have $5,200 sitting in our wallet or purse. So where is this currency held? A lot of it is held by foreigners, actually. So a lot of people overseas, US dollar is a very popular store of value. More than 2/3 of $100 bills are estimated to be held outside the US. You also have criminals. Oh, that did not want to do that. Okay. You also have criminals who have much of the currency to stay off the grid. But it's a large amount. And for some amount of time, as things like PayPal and Venmo are growing, a lot of people predicted that currency would become less and less important. People would carry less cash. But what we've seen is this amount has been going up really rapidly over time, amount of currency in circulation. So M2 includes M1, but also savings deposits, which are about 4 times bigger than checking deposits. Time deposits, these are CDs, largely, is another 0.55 trillion. And money market funds are almost $1 trillion. Okay, so that's the breakdown of these two types of money, M1 and M2. And you can see the currency get broken down by denominations. So you can see the amount of $1 bills in circulation, so this is in billions of dollars. $2 bills, $5 bills, 10, 20, 50, and 100. Some things that I'd like you to take away from this. So first, the total amount of currency in circulation. This is 2018 data, so that data that I'd given you on the previous slide is early 2020 data. See, it's about 1.7 trillion. Over this 20-year period from 1998 to 2018, the amount of currency in circulation grew by 240%, okay? And this is much larger than the growth so total currency has grown more rapidly than nominal GDP since 1990. So for nominal GDP, it's been about a 129% increase, whereas for currency, it's been a 240% increase. So contrary to the prediction of some that currency was going to become less and less important in the US economy, if anything, it's become much more important. And the growth in currency was especially rapid for $100 bills. So you can see they went up here over this time period, whereas some other currencies like the $20 bill have only about doubled. The $10 bill have only gone up by about 50%. So there's big variation across the $100 bills have had the most rapid growth over this period. And there aren't any denominations above 100 except $500 to $10,000 bills, and these have not changed at all. So these are not still being printed these are still not being printed. Okay. So now I want to pivot to talk about the role of banks in the economy. So as I showed you a couple slides ago, most money is in bank accounts, like checking accounts and savings accounts, not in currency. And so this is convenient because it allows people to buy goods and services without having to carry cash. Okay? So most people would prefer not to have to carry a lot of cash on their person all the time if they wanted to buy things. And so this is convenient for them to be able to put it in banks. Banks play a very important role in the sense that they act as financial intermediaries. So it allows savers a place to store what money they have, and they can convert all of these savings into a big pool to potentially provide others with money from which to borrow. Okay, so it's convenient. I have a checking account and a savings account at Stanford Federal Credit Union. They can use those savings to potentially make loans to other entities. Okay? And banks pay interest to savers and charge interest to borrowers. And these rates may vary with the type of saving. We talked a little bit about this with the loanable funds market a few weeks ago. Rates may vary with the type of saving, with the loan terms, and so forth. And banks aren't the only financial intermediaries, but they are the one that we're going to focus on in the class. So the role, what you can think of banks as doing is sort of summarized in this figure. So we have banks here in the middle. We have savers who put deposits into banks. And banks use those deposits to make loans to borrowers. Okay, so those are the three sets of actors. Now, banks have to pay interest to savers. Okay? And savers may decide to withdraw their money, so they have to be prepared for that possibility that tomorrow I may go to Stanford Federal Credit Union and say that I want to take out a big amount of money. And so they have to be prepared for that possibility. So that's the flow of funds from banks to savers. There's also a flow of funds from borrowers to banks. So interest payments are being made. Borrowers are paying interest payments, and they also have to repay the loans. Okay? So those are at a pretty high level, that's how the flow of funds works between banks and savers and borrowers. Okay? And in general, the interest rate that they pay savers, like at SFCU right now, I have, let's say, a savings account with an interest rate of 1% and a mortgage with an interest rate of 3.375%. That's just me. This is repeated for lots of other people. But in general, the rate that they're paying to savers is going to be lower than the rate that they're charging borrowers. Okay? Okay, great. And so let's now go into how a bank's balance sheet works. We're going to do a very simplified case. Banks are actually very complicated with respect to all of their assets and liabilities, but we're going to focus just on some of the primary categories. So assets that banks have include their reserves, loans that they make, and bonds. So they may buy government bonds. And when a bank makes a loan, so my wife and I, we have a mortgage on a big loan, that is an asset to Stanford Federal Credit Union. So it is a loan is an asset to a bank. Okay? Whereas liabilities, so the deposits that I, let's say, have at SFCU or that any of you have at your bank, these represent liabilities. These are what the bank owes to others. Okay? And the deposits are the largest category of this. So if we think on the asset side of the home mortgage market, the bank lends to a homeowner, and that is an asset that they now have. Sometimes the bank will then turn around and sell that mortgage to another institution, and that can be a secondary loan. So basically, assets and liabilities are the two main sides of the bank balance sheet. And when assets are greater than liabilities, the bank has positive net worth. So net worth is the difference between assets and liabilities. Okay? And so here I'm just going to draw out an example of a bank balance sheet. Essentially, this is often written to have assets on the left and liabilities plus net worth on the right. Okay, so let's imagine a bank that has deposits of $10 million. Okay, so those are its key liabilities, and its assets consist of, let's say they have loans that are worth 5 million. Government bonds that are worth 4 million. Okay, and reserves of 2 million. This is money that they keep in their vault or in an account, let's say at the Federal Reserve. Okay? So what's the net worth of this bank? What's that, Bill?
1 million?
Can you say it more loudly? Yeah, 1 million, correct. Yeah, thanks, Bella. So the net worth of the bank is 1 million. They have assets of 11 million and liabilities of 10 million. Okay, so you can think of this as reflecting a simple bank balance sheet. Okay? Now these loans, one of the things that happened in 2008, and that we're going to talk a lot about, I think it's on Thursday this week, is that the value of these loans can change over time if borrowers' ability to repay changes. Okay? So what happened in 2007, 8, 9, and the years immediately after that is many people found that they were unable to pay back their mortgages. Okay, so they ran into financial trouble. Maybe they lost their job and were unable to make their mortgage payment. Maybe they had bought a mortgage, that they had gotten a mortgage with an interest rate that floated over time and the interest rate went up and they couldn't afford it anymore. What can happen is the value of something like a loan can change over time. And so a number of banks saw that their net worth, which had been, let's say, healthy in 2006 and early 2007, as the Great Recession, financial crisis started to happen, their net worth started to decline because the value of a key component of their assets, mortgages, was plummeting. Okay? So this gives an example of how a bank can run into trouble. And many banks in the US ran into trouble about a decade ago if a non-trivial share of your borrowers default. So banks always expect some fraction of their borrowers to do this, but if the economy, starts not to do very well, many more may end up doing this. So the bank expects some fraction of their borrowers to default, but it can end up being much higher. Partly to cushion themselves against the risk of default, many banks did what's called securitizing their loans. They bundled together loans and then sold parts of it to investors. Okay? And so diversification is another strategy. So some banks will try to have their mortgages not all in the exact same geographic area. So if you're a bank and all of your loans are for houses in Silicon Valley and house prices in Silicon Valley fall, you're going to be very exposed to the risk of going into negative net worth. Whereas if instead you've got some loans in Silicon Valley, but also some loans in the Pacific Northwest, in the Midwest, in the Southeast, in the Northeast, you may be more diversified. But that diversification may not work if there is a really deep recession like we had from 2007 to 2009 in the US. Okay? Now, banks are also at risk for a timing mismatch. So typically, the amount of money that a bank has in reserve is much lower than its deposits. Okay? And so if all of the depositors just woke up one morning and decided that they wanted to withdraw half of their money from the bank, this bank would be in a little bit of trouble because they don't have enough in reserve to give to them. So there can be a timing mismatch. People may want their deposits sooner than the loan money is coming in, and so that can force banks to have to borrow in the short run. Okay. Pause there for a second, see if you guys have any questions on this so far. Okay, so we're going to talk a lot about the financial crisis and how it affected financial institutions. But before doing that, I want to talk about how fractional reserve banking works, so I mentioned that banks only keep some. Banks don't simply collect deposits and put it in reserve and leave it there. They end up loaning out money. And so what this means is that a certain amount of money can end up generating a lot of M1. And let's go through this. Suppose that all banks in the economy are required to keep 10% of their deposits on reserve. As we'll see in a few minutes, that's approximately accurate. Now let's take a step back and let's think of Steph Curry. Steph Curry, I looked this up last night. His salary in 2019 was apparently $37 million. Let's suppose that he deposits his salary into his account at the Bank of America, okay? Now after tax, the amount that Steph Curry gets to enjoy of his salary is more like $20 million after paying tax in California and to the federal government. Okay, so he pays his $17 million in taxes on the $37 million, takes $20 million, goes and puts it in his account at Bank of America. Okay? They may turn around then and lend $18 million. I just put in another basketball person here, part owner of the Los Angeles Lakers, and they keep $2 million in reserves. So they're required to keep 10% of that $20 million initial deposit in reserves, but they have $18 million initially in what you can think of as excess reserves. So they can go loan that money out. So let's suppose they loan out this $18 million, and then this person who borrows deposits an $18 million cashier's check into his account at Wells Fargo, which raises their assets and liabilities by $18 million. They keep $1.8 million in reserve, and they lend another $16.2 million out to someone else. Okay? All of these things are increasing the M1 and M2 money supply, and the extent to which they increase these can be calculated by this money multiplier formula. Okay? So we had that initial $20 million deposit. $2 million was reserves they had to keep. $18 million was excess reserves initially. This ended up leading to $18 million deposit, a $16.2 million deposit. 90% of 16.2 is 14.58 million. And this continues. Basically, you multiply that initial excess reserve amount times 1 over the reserve requirement. So with a 10% reserve requirement, that initial 18 million can create up to $180 million in new M1. There's like a multiplier effect associated with this. Now, this doesn't always work exactly because some banks may choose to lend out less than 90%, and some borrowers may not deposit all of their money in banks. Okay, but that's the maximum amount. So an $18 million in excess reserves can end up leading to up to $180 million in new M1. Probably won't go all that way. All right. But if the bank, that initial bank may decide with Steph Curry's $20 million to not loan out any of it, to keep it all in reserve, in which case it would only be, M1 is going up by much, much less. Okay, so, and as you can see, there's a link between the amount of money and the amount of lending that's happening. As M1 is going up, the amount of lending is going up as well. If you look in the US, there are 4 banks that account for a very large share of all bank assets. So almost half of bank assets are owned by 4 entities. So JP Morgan is the largest bank in the US. Bank of America is the next biggest, Wells Fargo, and then Citibank. And these are sort of the big 4. Number 5 is far below number 4. I believe it is US Bank Corp. They have less than $500 billion in assets. And all of these banks have assets significantly in excess of liabilities. There are almost 2,000 commercial banks in the US, but it's the top 4 that have 44%. I'm sorry, this should be 43. 43% of assets. And some policymakers are worried that these institutions potentially being too big to fail. And so you hear a lot of people worry that basically these companies know that if their net worth goes negative, let's say, that the government may come in and bail them out. And so that security blanket, we worry potentially about what effect it could have on their risk-taking. Maybe the banks will take greater risks than they should, knowing that the government will potentially bail them out. And that is, basically this is a trade-off. Being big is potentially good because of economies of scale in banking. But this being too big to fail, is the economy vulnerable to any one of these companies failing? Because banks are very interconnected, and if let's say JP Morgan Chase suddenly started to have a lot of financial difficulty, that could ripple through the entire economy and create a lot of problems. Okay, so that's what I want to cover on money and the intro on money and banking, and now I want to get to talking about the Federal Reserve. Okay, before I start, I'll see if you guys have any questions on this. Okay, good. So the Federal Reserve banking system in the U.S., it's a very important part of our banking system. The Federal Reserve is run by a board of governors in Washington, D.C., and there are 7 members of the board of governors, including the chair of the board of governors, Jerome Powell. The vice chair is, I believe, Richard Clarida, who used to be a professor at Columbia University. They have long terms, 14-year terms. So it's not like quite a lifetime appointment the way being a Supreme Court justice is, but it's much longer than being president or senator or member of the U.S. House of Representatives. Okay, these are appointed by the president, these roles, and confirmed by the Senate, but right now 2 of these 7 seats are vacant, which is not great for the existing 5 because that means they have a lot more work to do than if they had those additional 7 people around. And it is, this group is very important. In addition, there are 12 regional bank districts throughout the U.S., and this is a map showing the districts. You can see that San Francisco is the closest Federal Reserve district that we sit in right now. And you can see these districts were created many decades ago, like early in the 20th century. So you can see the San Francisco district has much more than 1/12 of economic activity in the U.S. It's got California. California is about 1/8 of the U.S. population. So even if it was just California, it would be more than its share, more than a 1/12 share. But it also has Oregon and Washington, Idaho, Nevada, and parts of, I think it has, this is me showing my ignorance, Arizona, and is that Colorado or is that Utah? Anyway, Carl, can you help me out? Because you're in from, which one? This one is Utah right here? Okay, okay, good. All of Utah? Does it look like it has all of Utah? All of Utah. Okay, terrific. Little geography lesson here. Great. And so, whereas you can see the Cleveland district or the Philadelphia district are much smaller, when these were drawn, this made sense, this 1/12 for the San Francisco district, because not that many people were out in the western part of the U.S. But now this district has huge amount more. And the person who is the president of the San Francisco Fed is a woman named Mary Daly, who spoke recently at CEPR. I'll tell you more about her next week. So the 12 regional bank districts, they regulate the banks and monitor economic activity that's taking place in their district. Commercial banks in an area elect the board, and the board picks the president. So New York and San Francisco are the largest districts, whereas Philadelphia and Cleveland are the smallest. And there are 3 main functions for the Federal Reserve. The first is monetary policy. Okay, and so this monetary policy is what we saw. I mentioned to you that Wall Street Journal, let's see if there's been any update to what the Fed is doing. So the Fed cuts rates by 0.5 point. Sorry. Oh, and that's not going so well. So anyway, Dow Jones is down by 3%. Not great. That's not what the Fed was hoping to achieve with this cut in rates of 0.5 point. So cutting rates, as the Fed has just done, is one of the important ways that they influence economic activity. Wow, that's not good. Okay, anyway. Hopefully it will turn positive sometime soon. Okay, so monetary policy. So that's the setting of interest rates, and we're going to talk a lot about that later in class today and also next time. The stability of the financial system is another thing that the Fed is charged with ensuring, and then serving commercial banks in an area. So a lot of commercial banks have accounts at the Federal Reserve, and the Fed also enforces consumer protection by, for example, ensuring banks don't discriminate by gender or by race in their lending or by age and what have you. And the Federal Open Market Committee, they are the body that has to decide to cut interest rates, as the Fed has just done. It typically has 12 members, including the 7 members of the Board of Governors. New York Fed president is always on this committee, and then it rotates between the other 11 presidents who's on the committee. But right now, the Federal Open Market Committee only has 10 members because 2 of the seats of the Board of Governors are vacant. Okay, so this is okay, so this is the FOMC. So the FOMC must have met yesterday to decide to cut interest rates by 0.5 percentage point today. So that is a pretty big cut, as we'll see shortly. Okay, so banks are regulated by not only the Federal Reserve, but by the US Treasury Department and by others as well. So US Treasury matters. So as a bank takes more risk, they're more vulnerable to shocks. And there are various regulations, government regulations that exist to ensure that banks remain solvent. Okay, so essentially one of these that we alluded to a minute ago is reserve requirements. A requirement that the bank keep basically in its vault or in an account at the Federal Reserve a certain percentage of their deposits. Okay? And this is in case customers want to withdraw. Capital requirements refer to a minimum net worth as a percent of assets. Now, sometimes it is very difficult to assess a bank's net worth because it may have a bunch of loans and it doesn't know if they're going to be repaid or not. Okay? So the value, sometimes it is difficult to assess what the net worth is of a bank. And then there are restrictions on investments. So it's not like JP Morgan Chase or Bank of America could suddenly put a lot of their deposits into Bitcoin, for example. That would not be okay. Whereas they can buy government bonds or make loans. And so it's the US Treasury that monitors risk-taking by and the net worth of banks and S&Ls. And they require banks to change course if they are taking on too much risk or if their net worth is too low. There's another government entity called the National Credit Union Administration that regulates credit unions, and the Federal Reserve Board regulates these big bank holding companies. And most of those banks that I mentioned earlier, Bank of America, JP Morgan, those are big bank holding companies. But the one that I want to stress the most today, relative to at least Treasury and Comptroller, is federal deposit insurance. So there's something called the Federal Deposit Insurance Corporation that insures depositors against the risk that their bank will go bankrupt. So a bank if word were to get out that a bank was suddenly, its loans were not being repaid, then depositors may get anxious and want to go and withdraw all of their money. But up to the first $250,000 in each account is insured by the FDIC. So if JP Morgan Chase tomorrow went bankrupt, to the extent that people had accounts with JP Morgan Chase, FDIC would come in and kick in this $250,000. And so this essentially eliminated the risk of bank runs at banks with insurance, at least for people with deposits of less than $250,000. The Fed, when we think of the role of different policymakers, is typically considered the lender of last resort. So if a bank is having difficulty, suppose that depositors are wanting to withdraw their money, they can come in and give loans to these banks. And part of the reason that they may want to do this is that there's the possibility of a ripple effect. if one big bank were to fail, JP Morgan Chase, Bank of America, Wells Fargo, this could have a ripple effect on other banks. And so the Fed exists to provide liquidity if they're not otherwise available. And there are a lot of concerns, though, about the moral hazard effects of this. And I talked a little bit at the break about this. With a safety net available, does that encourage banks to take on more risk than they should? Okay, so now I want to talk about the three main levers for the Federal Reserve. The first one, and the one that's most frequently used, is open market operations. So this is the purchase and sale of government bonds. And I'll walk through an example of how this affects the market for loanable funds in a moment. Essentially, this is purchases or sales of US Treasury bonds, and this influences what we call the federal funds rate. So I wrote this slide deck up last night when this rate was at 1.5%. It is right now at 1% as of this change this morning that the Fed announced. This is essentially the interest rate that banks charge each other for overnight loans. Okay, and the open market operations are by far the most frequently used tool of monetary policy that basically influence purchasing or selling. And I'm going to walk through an example, a relatively simple example of how the U.S. How these sales can influence the money supply. Okay, so this is the one that was used today and is the one that's used most frequently. Another way that the Fed can, another lever that they have to influence bank activity is reserve requirements. And these are a pretty rarely used lever. For the most part, these reserve requirements are 10% of the amount over 127 million. The first 17 million, no reserve requirement. There isn't a reserve requirement because it's sufficiently small that the Fed isn't worried if it needs to come in and kick in 1.7 million. So there's no reserve requirement for the first 17 or so million, a few percent for the next 110 or so million, and then 10% over that amount. Okay? And the final rate is the discount rate. This is the rate at which banks can borrow from the Fed. As of last night, this was at 2.25%. I think this has probably changed to 1.75%, though I need to check that. I'll let you guys know in class on Thursday. Okay, so these are the three main levers that the Fed has. And let's walk through an example of how a bank balance sheet can be affected by a Fed purchase of $100 million in bonds and or securities from a bank. So I want to start out with a bank that has assets and liabilities. Okay, I'm going to say that this bank has deposits of $2,800 initially, and net worth, let's say, of $300. Okay? And then over here on the asset side, so that's $3,100 in liabilities plus net worth. Let's suppose they've got reserves equal to 25% of their deposits at $700. They've got government bonds worth $400. And then they've got loans of $2,000. Okay, what I'm doing here is going to be simplifying to a significant extent how these open market operations affect this market, but it's accurate. The concept here is accurate. Okay, so now suppose that the Fed buys $100 million in bonds and or securities from this bank. So this is pre. Okay, what's going to happen if they're buying $100 million in bonds and or securities from this bank? The total amount of bonds that this bank owns will be what? What's the value of the bonds if they just sold $100 million in bonds to the Fed? You've got the microphone, Cube. You want to take a try? Or I can. Maybe I'll ask Carl.
Okay.
Carl, do you know? You think I can throw it to you? No, I better not try. That would be. Does anyone want it? Okay, so what amount in bonds does this bank have? Come on, you want to make me look good in front of my friend from 30. Here we go. Thank you. Sorry, almost.
So if the Fed buys 100 million in bonds from the bank, wouldn't the assets decrease by 100 for the bank? So like the bonds.
Well, let's just do the
300?
bonds. How much in bonds would the bank now have if they sold 100?
300.
300, exactly. Okay, now they've got cash from the Fed. So what would happen to their reserves?
It would increase by 300. I mean by 100.
Yeah, so those would increase to 800. And then loans are still at 2,000. Okay, nothing has changed over here on the deposits or net worth. They're still 2,800 and 300. Okay, and if this bank had been trying to keep reserves at about 25% of deposits, they're now going to decide to turn around and loan out this money, this extra 100 million that they have, increasing their loans to 2,100. Okay, and so bonds will stay at 300, and reserves now will fall from 800 back to 700, and deposits are still 2,800, and net worth still at 300. Okay, so this is post the Fed, after the Fed purchases, and then this is post with a new loan being made. And so when the Fed is purchasing bonds in this way from banks, they are trying to stimulate the banks to make more loans, okay, and increase the amount of economic activity. So if you were to look at this in essentially a supply and demand type framework, so here we've got the market for loanable funds, here's the interest rate R, and here is the quantity of loanable funds. Okay, you can think initially there's some supply S0 and some demand D0. What this essentially is achieving is a rightward shift in the supply of loanable funds. Okay, and that initial purchase, that big purchase of bonds from the banks is going to lead to a reduction in the interest rate from R0 in this example down to R1. Okay, any questions on this? Okay, great. So this just basically describes how monetary policy can affect interest rates. And monetary policy can be either expansionary or it can be contractionary. Okay, so what I was just describing was expansionary policy, where they are buying government bonds from banks, and that is leading to a reduction in the interest rate. So expansionary lowers rates and encourages borrowing. And that is exactly what the Fed decided to do this morning through these bond purchases. This represents a rightward shift in the supply of loanable funds. And the Fed is hoping that this morning, this reduction of a 0.5 percentage point is going to lead to essentially lead to a reduction in the interest rate and spur some economic activity. Question right here.
Yeah. Can you explain where the numbers from the table came from?
I just made them up. So they were not taken from like the JP Morgan or any of that. So you mean the values of 2,800 in deposits and 300 in net worth?
Yeah, and like the bonds.
Yeah, so I just was like, let's pretend that at baseline the bank, I think they had what, like 300 in bonds and 2,000 or 400 in bonds and 2,000 in loans. Different banks will differ with respect to what fraction of their portfolio is in bonds, like government bonds, versus mortgages, versus home equity loans, versus credit card loans and so forth. So banks will differ with respect to their portfolio, but that's not meant to be like a representative bank. Yeah. Okay, great. Do you have another question? You good? Okay, great. So this represents a rightward shift in the supply of loanable funds and leads to a lower interest rate and a higher quantity of loanable funds. And basically, the fall in interest rate is happening due to the higher bond price. So the Fed, by buying these bonds, is raising the price of the bonds and the interest rate falls. So if the price of a bond that pays off in a year goes from 98 to 99, that means the interest rate, the associated interest rate, is falling. And then if instead the Fed was doing contractionary policy, it would represent a leftward shift. And so the Fed targets the federal funds rate, and this is the rate that banks charge one another, and this involves reserves held at the Fed so they can observe this. And one of the things, it's not like this interest rate is changing in a vacuum. When the federal funds rate changes, this tends to change other rates. So it tends to lower the rates on other mortgages, like mortgage loans. The rate will tend to go down. Car loan rates will tend to go down. And this can act as a way to spur economic activity. Okay? And so at some level, we can think of expansionary monetary policy causing a rightward shift of the aggregate demand curve. So when let's suppose right now we're out at a point like this with output at E sub 0 far below potential. If we do expansionary monetary policy, lower interest rates, that is going to tend to spur consumers to purchase more things and businesses to undertake more investment, and this is going to lead to a rightward shift, okay, in aggregate demand. And hopefully, if they do the right amount, we'll end up right at potential output. But as I said, it can be very difficult for the government to figure out how much stimulus is needed and by how much and how long will it take to have an effect. So you can think about the causal effects of a monetary expansion. There's an increase in the money supply. So when the Fed bought that government bond from that bank went out and made loans. As we saw earlier, that's going to increase the money supply through a multiplier effect through these open market operations. The interest rate falls as the supply of loanable funds shifts to the right, and consumption and investment increase as aggregate demand curve shifts to the right. So this can result in a higher output and price level, but all of this is, what I have been giving you in these examples is highly simplified relative to the complicated world we're in right now. But you can see that the Fed today is trying to take some aggressive expansionary monetary policy. A 0.5% drop is a bigger drop than they have done since we were back in the Great Recession or back in 2008 and 2009. And so here today is the last slide for today. I want to just talk about the evolution of the federal funds rate from 1999 to the present. So as you can see, this does not have the most recent, So today this just went down somewhat, but we can look at several different periods. So interest rates, to some extent the Fed is always trying to think about, should they tap their foot on the brake, should they put their foot on the accelerator, or should they do neither with the economy? Okay? In the late 1990s, the economy was growing very rapidly and unemployment was falling quite a lot. So the Fed was tapping on the brakes by raising the interest rate to try to ensure that the economy didn't get overheated, that we didn't have output above potential where inflation was going to result. Okay? And then they stayed fixed for a little bit in 2000. And then as the economy started to go into a recession, and this was amplified by the 9/11 terrorist attacks, the economy tanking more, you can see that they basically entered this period where they entered into expansionary monetary policy. So this initial period here was contractionary monetary policy, whereas here this was expansionary monetary policy. So rates were reduced beginning in 2000 as the economy started to enter into recession, and they continued lowering rates for a while over the next few years. And then beginning in late 2004, started to raise interest rates again. The idea was that the economy was growing, and this all happens gradually. The economy was growing healthily, and they wanted to avoid the possibility of the economy getting overheated, okay, and stopped when they got to a rate of about 5.25. This is probably about 5.25 here, and stayed fixed for a while. And then beginning in 2007, this is when just a gigantic cut in interest rates happened over about an 18-month period. There were large reductions in interest rates as economic conditions deteriorated. And one of the things that people who follow the Fed were happy about when you had this 5.25% rate, there was, sorry, when the rate was at 5.25%, there was a lot of scope for it to fall further. One of the things that people have been worried about more recently is with the rate peaking at just 2.5% recently before being cut, the Fed doesn't have as much of a weapon in its arsenal. It basically stayed at 0% for 9 years. It couldn't really go. They elected not to go negative. So for basically 7 years, about 7 years here, this rate was basically flat around 0%. And then the Fed had been trying to raise rates as the economy was growing healthily again, but they didn't get nearly as high as they were back in early 2000s or in around 2006-07. They only were able to get to 2.5% before they decided to start reducing again. And all of this is basically a calculated effort by the Fed to keep output growing at a healthy rate. Not too fast, not too slow, just right, the Goldilocks amount of growth. And we'll see if this 0.5% reduction, let's see where we're at, if anything major has happened since I last checked it. Yeah, it doesn't look good. Anyway, I hope it gets better before we're in class on Thursday, but we'll talk more about this on Thursday. Hope you guys have a great couple days, and feel free to come up if you have questions after class.